As long as the music is playing, the former chief executive of Citigroup so memorably recommended in 2007, you've got to get up and dance. The problem with Tokyo stocks in 2016 is that the music is still blaring away, but it's becoming increasingly undanceable, an experimental mashup of Money, 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 the Internationale, and I Fought the Law, played with a manic glint by the Bank of Japan. The underlying theme, defined by the central bank's 9 trillion yen buying of exchange-traded funds in the Abenomics years since 2012, has always been unusual. Day-to-day trading anomalies are becoming more frequent, brokers seem less nervous about labelling this a nationalisation of the stock market, and a couple of months ago, Japanese asset managers endured the pantomime of designing implausible new ETFs, primarily to be bought by the BOJ. But since July the 29th this year, when the BOJ announced that it would nearly double annual ETF purchases to 6 trillion yen, the weirdness has become more striking and the swings of sector rotation more violent. The clearest measure of this has been the Nikkei Topics ratio, a gauge that compares performance of Japan's 2 main stock benchmarks and has just seen the Nikkei's outperformance of the Topics blast out to an all-time high. It matters because of the very distinct ways in which these two are constructed, the stark differences in sector weightings, and the fact that the BOJ, for technical and liquidity reasons, is currently buying about 30% more ETFs based on the unevenly construed Nikkei than on the more transparent Topics. The Topics is a broad market cap-based index, while the Nikkei, described by CLSA strategist Nicholas Smith as a Flintstones index from an abacus age, is an average of just 225 share prices, unadjusted for free float, its membership determined opaquely, and giving a handful of stocks wildly outsized weightings. This difference didn't matter so much in the past, but does with the BOJ on target to own 5% of the whole Tokyo stock market by next year. Hedge funds may relish the cacophony of distortion. Everyone else, including the big global funds, may look for something more melodious.